Hi, my name is Brenton Harrison, and we're here today to talk about how to calculate how much life insurance you need the same way a financial advisor does it. Let's get started. If you're subscribed to this channel, and if you haven't already, please do and check out some of our other videos, then you know that we talk a lot about the common principles of insurance on this channel. And not just the common principles, but the common threads amongst different types of insurances, be they car insurance, homeowners insurance, disability insurance, and in today's case, life insurance. And to me, the overarching principle, the biggest common thread amongst different types of insurance, is that they are ways to transfer risk from yourself to the backs of an insurance company. You're transferring the risk that a bad event happens that you have to pay for, and instead placing it on the insurance company in exchange for money. That is the thing that ties all different forms of insurance together. If you have car insurance, you might pay $100 a month every single month, so that if the worst happens and you get in an accident, or even worse, total a car, and it costs $10,000 to fix, you can have the insurance company pay the bulk of those costs instead of you having to pay dollar for dollar. You have, for a fee, transferred the risk of paying that $10,000 from yourself to the car insurance company. Well, the same is true for the topic of today's video, life insurance. When you decide to purchase life insurance, you are trying to reduce or transfer the risk that you might die before you've had the chance to put aside enough money for your family to be okay. As a financial advisor, I have clients who come to me with these types of questions. Hey, I've got 2 kids who are in school. I want to make sure that they can go to the college of their choice if something happens to me. Hey, my spouse works from home or doesn't work full time or doesn't work at all. If something happened to me, I need to make sure that my income is replaced in the event of my death. But how do I know how much is too much, how much is too little, and how much is just enough? And every single financial advisor is going to have their own philosophy on what amount of insurance is appropriate. And I'm going to walk you through a couple of those ways that an advisor can come to that number. But the important thing to understand is you may be watching this video and not be under the advisement of a financial advisor. What if you're sitting here trying to figure out how much is appropriate on your own? If you don't have that resource, if you don't have that referral, if you don't have that trusted person you can ask, I want you to have some insights into how they do these calculations. There are multiple ways you can factor in certain insurance needs, like providing for a kid's college funding, like providing for a spouse, like providing for another loved one or family member that's dependent upon you in terms of your working years. Today, we're just going to talk about how advisors can calculate ways to replace your income. So we're not going to talk about, hey, I want to pay off my mortgage. Hey, I want to make sure that college is provided for. We're just going to focus on the different ways, 2 of the major ways that financial advisors aim to replace your income when it comes to finding an appropriate amount of life insurance. The 2 ways that we're going to cover are human life value and the 5% rule. And we're going to start with human life value. Human life value is a really frequently used tool by financial advisors to try and associate a dollar figure with the impact your death might have on your family and loved ones. If you work every day now and you work outside the home and earn an income, then it kind of makes sense that if you were to die today, when maybe you thought you had 20 or 30 years left of work to be done and income to be earned, well, there's a big loss there. Every single year of that 2030 that you weren't here, that's money and income your family might have been depending on that they're not going to receive because you're not around to earn it. But even people who don't work outside the home, maybe a stay-at-home spouse or a caregiver, can greatly underestimate the monetary value that their ability to stay home has on a household. Whether you stay at home, whether you work, whether you make a ton of money, whether you make a little money, all of us have a human life value. And it's the financial advisor's job to help determine that human life value as close as possible when they're suggesting an appropriate amount of life insurance. So what are those steps that they take to find that number? And what are the steps you can take at home to find yours? Step 1 in determining your human life value is calculating how much income you would lose if something were to happen to you today. We're going to look at an example, and we're going to use a guy named Johnny Doe, and Johnny's an engineer, and we're going to assume that he earns $75,000 of income, and he has a young family. Maybe he's got a spouse and a child that's Let's call them 4 years old and 2 years old. And he wants to make sure that he provides or replaces his income until his youngest is out of college. So he's going to need to replace his income for 20 years in the event of his death. The first thing we do is we calculate $75,000 of lost income times 20 years in terms of how long he wants to replace it. And his total lost income is $1.5 million. That's a pretty basic way of calculating lost income. And you might say that it's too basic. It doesn't factor in things like inflation. It doesn't factor in things like bonuses or just general pay increases that many people experience over the years. So very simplistic. And you might say that that simplicity will factor in down the line when I help evaluate my preferences in terms of how you should calculate your life insurance. But for step one, we calculate the lost income, and we find that over the course of 20 years, he would have lost $1.5 million in the event of his early death. The next step is to apply a discount factor. Before we get into what the discount factor is and how it pertains to human life value, you first must understand some assumptions that a financial advisor makes about the family that's left behind when you die. We've already covered that if something were to happen to Johnny, he would have $1.5 million of lost income that his family would need to replace. And you would think that that would mean that all he needs to do is go and get a $1.5 million life insurance policy. But that's not really true. Why isn't it true? Well, let's think about it. If you were to die and your family brought me a large sum of money, far more than they need to live off in a single year, and they said to me, Mr. Harrison, this is our loved one's legacy. This is all the money in the world that they left to us. We want to make sure we're good stewards of it and that it lasts the length of time it was intended to last when they purchased the policy. Well, I'm going to say, okay, take out what you need for the first year to live. And I'm not going to, in most cases, tell you to take the rest and stick it in a savings account or a checking account. What that means for Johnny, though, is that instead of him having to purchase a full $1.5 million in life insurance, we might be able to run projections on the amount of interest we get with those leftover funds year after year after year. And we can use that projection to find a smaller amount of insurance that he can purchase, where over the course of time, by his family investing that leftover money year after year after year, it will produce 1.5 million over that span. I know that's complex without looking at some numbers, so let's dig back into the example. We've covered that over the course of 20 years, Johnny Doe would lose $1.5 million, or I should say his family would lose $1.5 million of his income if he were to die today. And remember, we're going to operate on the assumption that they were going to take whatever they're given in terms of any life insurance proceeds, and they're going to invest whatever they don't use in those early years. We're going to assume that they're going to get a 5% return on whatever of those assets they put in the market. And that 5% is the discount rate. It is the rate of return we're going to assume his family earns on any invested assets upon his death. When we use these inputs, $1.5 million of lost income, but a 5% discount rate, we come to a human life value of $565,334. This is the amount of money that it would take for his family to take $75,000 each year and invest the rest at a rate of 5%. And if they do that over the course of 20 years, they will have access to $1.5 million. He doesn't need the 1.5. His family needs $565,334 to replace his income. And this is his human life value. Once you've found your human life value, you can add in other variables that you want factored into your insurance needs, like college costs, like emergency funds, and you can find the total amount of life insurance you need to purchase. In our example, we take the human life value of $565,334. We add a college fund of $100,000 and maybe other debts that they would want paid off in the event of their death of $50,000. And we come to a total life insurance need of $715,334. As an advisor, I can tell you that of the two methods of calculating insurance needs that we're covering in this video, human life value is not my favorite. In my opinion, it can lead to a low number in terms of the amount of life insurance that a person needs for a couple of reasons. One reason is that financial advisors and even calculators for life insurance can often use discount rates for human life value that are far too high, in my opinion. And what that means is they are assuming that you have too high of a return on those life insurance proceeds than is realistic in my experience. For many of these calculators, when you put in a rate of return for the discount rate, like 5% or 6%, it unfortunately assumes that you get that rate of return every single year. So if you put in a 6% return for the discount rate, it assumes 6%, 6%, 6%, 6%, no matter how long you have for that period of time. That's very different than the way the stock market works, where you might find an investment that has a 6% average, but that could be a 12% return one year and 0% return the next year, but it still averages out to 6%. Unfortunately, that's not modeled in many calculators, and the difference between those two in terms of the amount of life insurance you need can be astronomical. The second reason I'm not a huge fan of human life value is it doesn't take into consideration things like pay increases. It doesn't take into consideration fully things like inflation. So if you're looking at lost income right now, you may not factor in the fact that you're on a track to have your income double or triple over the years. You need to project with your life insurance, just like you would project with other areas of your financial planning. If you're making $50,000 right now, but you're in grad school so that you can make $100,000, why would you base your life insurance needs off of $50,000 when the rest of your life is set up for a life of $100,000? To illustrate that wide gap in what you can find from one practice to another, let's go into the second form of calculating insurance needs, the 5% rule. The 5% rule does share some similarities to human life value, but it leads to much larger life insurance needs. And for me, I would much rather you not die, but die with your family receiving an amount of life insurance that's too much than them getting an amount that's too little. So this is my preferred way to calculate life insurance needs. Here's how it works, and it's pretty straightforward. The amount of income your family would need each year upon your death needs to be 5% of your total insurance coverage. As an example, if your family needs $50,000 per year upon your death, you should have life insurance of at least $1 million, $50,000 being 5% of $1 million. Now, why do they use that percentage, and how is it similar to human life value? Well, it's more similar than you would think. 5% is what I would call a moderate rate of return. And remember, I said that if your family came to me with the insurance proceeds upon your death and I invested those proceeds, I'm going to be trying to get a conservative or a moderate rate of return. And 5% is considered a moderate rate of return. By adhering to the 5% rule, you're saying if I can take this pool of money and I can earn 5% per year, I can have the family live off of that 5%, but I'm going to earn 5% on the money that's left in the market. So hopefully the next year when they come and need more money, it's as close to the original total as possible. Let's look at it another way. If your family brings me $1 upon your death, then I'm going to say, hey, you can live off of a nickel each year, 5 cents out of that dollar. Now we have 95 cents that's left in the market, and it's going to get a 5% rate of return. And at the beginning of the next year, your family is going to come back to me and say, hey, we need more money from that investment account so we can live through the next year. Now, we won't be right back at $1 because we only had 95 cents growing at 5% instead of our original dollar, but we'll be close. So it is aiming to delay the period of time before these funds are extinguished and make sure that they last as long as intended. Let's look at an example, and you'll see how even though we're using 5% as the discount rate with human life value, and we're using 5% as our target goal for our life insurance proceeds, how they can lead to wildly different numbers. So we're going to go back to our guy, Johnny Doe. We're not going to switch it up. It is the same person that we're using in our example, and it's the same $75,000 of income that he's earning now. But now with this 5% rule, we can also include an income target. This is something that I do as an advisor, where I don't just ask, what are you earning today? I ask, Is this the top of your profession in terms of income, or do you think you're on track to earn a significant amount more? That higher amount is going to be the income target. So as an advisor, I'm going to listen to him if he says, I make $75,000 right now, but I'm getting my master's degree or I'm about to get a promotion. And I think when I get that promotion, I'll be earning about $125,000. So even though 75,000 is his income now, I'm going to use an income target of 125,000, and that's going to be the amount that I use for the 5% rule. 125,000 is 5% of $2.5 million of insurance. So if you'll recall, the human life value for Johnny Doe was a little over $500,000, but we're looking right now, even before we add in anything like college funding, at a need of $2.5 million of insurance, a significant difference. Now, when we add in things like the college fund, which is the same amount we used in the previous example, and other debts, the $50,000 also used in the previous example, we lead to a funding need for insurance purposes of just under $2.25 million. As a young family, as a young professional, you don't want to always base your life insurance needs off of what your financial situation is now, because your financial situation will hopefully change. Most of us are trying to make more money. Most of us are trying to make financial lives less stressful. We're trying to prepare for things like our children or our loved ones in the event of our death. So if I base it off of what I'm doing now, I'm losing the opportunity to plan for the progression that I had intended for my financial life. And to me, the 5% rule is something that makes me more comfortable when I'm making recommendations to clients. Now, for human life value for an older couple or an older professional who has a few years left for retirement, they're really trying to just get the exact amount they need, which you really can't know for sure, or they're trying to limit how much they can purchase, human life value might be appropriate. But when you're projecting and you have years and years and years of income earning ahead of you, I'm more comfortable with the 5% rule. And now I'm going to show you a calculator that uses that 5% rule and see how close we can get to what I'm talking about. Now, remember that Johnny Doe in our 5% rule example has $125,000 as his income target that he's trying to replace for 20 years. And we're trying to see if we can find an online life insurance calculator that will give us an idea of what number they feel is appropriate. I'm going to see how closely I came without looking at that calculator to having an appropriate amount of insurance that I recommend to this client. As an advisor, I'm always going to double check these things, but with time, with repetition, you do start to see trends, and it gives you at least a base idea of what amount would be appropriate. And with you understanding these principles, you should hopefully be able to do the same and be able to just double check your work. What we're going to do is we're going to use a life insurance needs calculator similar to what you might find online. This one comes from lifehappens.org. They're a nonprofit that does insurance advocacy. This is not my recommendation that you use Life Happens. Just want you to have an example of what you might find if you're doing this on your own. On their calculator, it says, how much annual income would you like to provide if you were no longer here? Remember that Johnny Doe earns $75,000 now, but he's on track to earn $125,000. So that's our income target. That's what I'm going to use for our calculation. The next question asks, how many years should income be provided after you're gone? For this, we said that he has two fictitious children. Their ages 4 and 2. We're going to assume that he gives them 20 years of additional income that he would be replacing in the household. That would get his youngest to age 22. How much debt would you like to pay off immediately? I believe in our example, we used $50,000. It says, how much would you like to provide for childcare? Now, later on in these, I've done this calculator before, not for this example, but I've used their calculator before. It will ask a specific question about college funding. It'll ask how old his kids are. It'll ask what state they live in. It will ask if they plan to go to public or private school. But depending on the state, depending on if you choose public or private, that can wildly skew the numbers. So we're going to use exactly what we use in our example. And even though it's not technically childcare, we're going to put this $100,000 there with the intention of that being for college funding. Exactly like I said, it's going to ask how many children require college funding. We're going to skip that, and we're going to have the $100,000 be the substitute in this example. And how much would you like in an emergency fund? We're going to put that at 0 as well. How much personal life insurance do you already have? 0. Your estimated life insurance need in this example is $2.261 million. If you recall, when we did this with no calculator, we came to just under $2.2 million. No, I have not used these inputs before. It's just familiarity with these types of calculators and ones that use human life value versus ones that use the 5% rule like this one clearly does. Even without having to go through the steps, just from experience and repetition, we got pretty close to being on the nose where we said just under 2.2. This says just over 2.2 by using the 5% rule to estimate how much insurance is appropriate for Johnny Doe. Even though I'm talking about the ways that I feel are most appropriate to calculate how much insurance is appropriate, the most important part of this whole video is that you calculate how much is appropriate for yourself and secure coverage. Over all these different things, no matter your preference, the most important thing is that if you feel you have an insurance need, that you go get a policy for you and even your loved ones if you're dependent upon them in the event of their death. We're going to put a link to a life insurance needs calculator that you can actually check out on my website so you can try to find the appropriate amount of coverage for you. Once again, my name is Brenton Harrison, and I hope this video has been valuable to you in your financial life. If you haven't already, subscribe to our channel and subscribe to the notifications so you know when new content is released, and we'll keep bringing it to you as frequently as we can. Have a good one.